Let's start with Christof Rühl taking us on a slightly sort of macro view of that. Christof Rühl, of course, Senior Research Scholar, Center on Global Energy Policy at Columbia University, and with Mike, kick off each month for us with this reflection and outlook. So, Christof, your thoughts as we end Q1, the idea of the Fed has peaked, now a lot of outlook for cutting rates and so forth. What are you buying at this stage as you reflect on Q1?
I don't see this bullish picture like you do. The same Goldman Sachs, which now say it's a dip, but just a few days ago have taken back the $200 forecast. And when you look at how was it one quarter ago, the price somewhere in the 90s, and people like you probably arguing it might go above 100, and I just would repeat what I said earlier. There's enough oil in the world. Production even in the US is ticking up. Buffers are very small, so there's always a chance for spikes when anything goes wrong. Potential for things to go wrong is huge, of course. But we are seeing a trend since the beginning of the year, which is stable and downward pointing from the 90s into this corridor between 80 to 85, where it was for a long time. And now, who knows, maybe a little bit below that corridor. And I think the big picture is driven by short-term variations, fluctuations in oil prices and stock markets, driven by the normal speculation on interest rate increases, growth in the US, growth in Europe, growth in China. But the longer-term picture becomes clearer, and it is, number one, slow growth in China. So by that, I mean 4 to 5%, not 7, 8, 9%. Number two, no big bounce back without an additional stimulus in China, for the simple reason that the Chinese have not, during their long lockdown, doled out money to consumers in the way Europe and the US have, which explains this massive bounce back which we have seen in those countries. Number three, steady growth in Europe and the US. So whether this will turn technically into a recession or not almost doesn't matter. It's relatively high growth, relatively low low unemployment, mostly still on the back of these big handouts which have happened during the COVID time. And to that, number 3A, no banking crisis, because I currently see the current hiccups happening clearly because of management mistakes and problems in isolated banks, not leading with a very low risk of leading to a systemic bank run. So I think for that financial instability threat, we have to wait a little bit longer. And when you step back, then overall a situation where the world sort of seems to be growing at a healthy clip, and I would expect stock markets at some point to come back, but where on the energy side, supplies are sufficient to accommodate them. So then from that stable position, we have to look at the but, and the biggest but, of course, of all would be the Ukraine war and what that would mean. And I still think there is a significant risk sleeping there, because I do think the military situation and the political noise around it point to the West, or large parts of the so-called collective West, having made up a decision that they support the Ukraine, also not only defend themselves, but also in their coming offensive, in their attempt to put pressure on Crimea by cutting the eastern from the southern front. And if that happens, and if Russia's military advances unravel faster than we now think, and as fast as some military experts think, and if the Russian government would be cornered, then they would, of course, use the oil market in this ongoing economic warfare to derail the Western stable growth. And that is a high probability. No, I mean, it's below 50%, but still a relatively high probability event waiting to happen.
Right. I wanted to get your thoughts on this sort of narrative that grew during the financial shock, which the banking shock was that it put the central bank policymakers between a rock and a hard place, so to speak. Although we were pre-financial shock, generally consensus was that we were getting to the peak rate plateau. Maybe they were going to be a bit more robust than initially thought in the first quarter, but ultimately we had got to near peak. And what's changed dramatically, it would appear, is that the peak narrative is still there, but the drop off now of rates forecast by the markets in the second half of the year is quite sharp. Your thoughts on where central banks go now? Obviously, inflation is still printing quite sticky and chunky above all targets. Where do you buy into this rock and a hard place? Where do you think the central bank policymakers go, and particularly US, Europe?
It's a rock and a hard place and something else. It's this famous trilemma. You would expect in times like this, central banks to face a dilemma between when to create a recession is worse than bringing down inflation. So the trade-off being lowering inflation and raising unemployment and lowering output, creating a recession. Now it is that their trilemma, as somebody has said, is between lowering inflation, avoiding a recession, and stabilizing the banking system. To understand that and where this will go and why this is indeed, I think, dangerous, is you have to step back a little bit. And then what we have is a fundamentally different situation from 2008 in the sense that global debt levels on the private sector, but also in governments, have risen substantially. And they're completely at record levels in the aggregate between the components of the private sector and for governments in major economies. And that makes these economies, of course, and their banking sectors vulnerable to increased interest payments down the road. In the private sector, which makes the banks vulnerable, and also for the governments. And people like me have for a long time, including on this show, argued that the central banks will be very unlikely in Europe and in the US at least to bring inflation rates back down to 2%, because they will have to find a way of deflating the debt of their governments. And there is an element of what is usually called financial, repression building up here, in the sense that the treasuries the world over, and at least in the leading G7 economies, want to lower their debt levels. And one way of doing this is to keep moderate inflation levels in place rather than bringing interest rates so up that they will snowball from the point of view of governments. And so what we are likely to see is a balancing act between inflation rates staying above the 2% targets and central banks needing to find excuses for leaving them at 3 or 4%, and still meandering into a world where the electorate usually expects even more government expenditures for climate change, for war expenditures, for whatever we've gotten so used to, the government pumping money in the economy or the central banks lowering interest rates and doing QEs. That will be very hard to wean us off even to inflation levels around 3 or 4%. And then in the midst of all of that potential instability created by this process of deleveraging, which still takes place to get inflation rates from where they currently are lower. And I think the risk that we see emerging market economies, less than AAA, BBB rated companies and others tripping over as interest rates continue to either increase or stay at current levels is substantial. And the more these debt levels in the background limit the central bank's activity level anyway, the less room for maneuver they have to take it easy on the interest rate side. So I think down the road, it is the forces created by these huge debt burdens at financed at extremely low interest rates. It's ultimately, you could say, the punishment for years of spending with very low interest rates and with QI, as if there's no regard for any kind of fiscal discipline. That bill is still to come, and that means that there is a relatively high risk of financial instability and contagion in the cards. Yes.
But Christof, as you look to Q2, what is your outlook for what could change from Q1? We're coming out of winter, we're going into maintenance season. Obviously, the war you mentioned in Ukraine typically heats up in the spring. What are you looking at Q2 as milestones to keep an eye on?
I think, again, if you put into perspective what you just discussed about price caps, and the world would be at exactly the same oil price, I would postulate, with or without the price cap, which doesn't bite. And for products, it's even more drastic because there is a lot of tinkering taking place. And when the rules are, when you modify it in a third country, then you can re-export it. So I think the sudden increase of refined products from the Middle East and the sudden increase of imports there are related. Looking forward, it's going to continue to be, no matter what Goldman Sachs now claims. I don't understand how they get away with making these claims all the time. I would be poor if I would follow them. But no matter those claims, we will live in a world which is without disruptions, well supplied with oil. Also in a world where now it seems to be that finally American production comes on a little bit. which is going to grow at standard rates in the West, moderate rates in the East. So I think what we really need to watch out for, number one, is the war, because there is a promised counteroffensive, and none of us knows much about it. At least I don't know much about military techniques. But if the war changes, then everything else will be shifted around again because it's such a high priority. So that's the number one risk. Number two is that we face an uncertainty on the economic side of how the world's perceptions will shift from the central banks being all unified in bringing inflation to this 2% target, to the realization that no, this is not going to happen despite all the rhetoric. There will be a permanently higher sort of basic rate of inflation, some, who knows, 3+%, and how central banks then react to that, and how those actors who have to correct their leverage and their interest rate exposures will act to that. So that's another very important thing. And number three is we are seeing then in Europe the adjustments for a bit early to say, but long-term planning for the next winter to start, with the role of natural gas sort of permanently altering as Russian supplies will not resume. So this will be a boost of natural gas projects from Africa and other places in the world, new LNG projects, I should say. And the question which arises here is in a world where commodity prices are no longer so sky high and are maybe beginning to de-escalate, and after the war is over, certainly will de-escalate a lot. What does that mean for the growth of renewables? How big is the appetite and the technical ability really, and we should see that first in Europe because it's most advanced in that respect, to push ahead with the renewables agenda at a time where governments are not as rich, at a time where there's competition from a richer or more spendthrifty government in the US in that respect, and at a time where the costs of renewables are no longer coming down as we used to. So it's really about finding smart solutions to now continue to bring up the share of renewables in power generation in Europe in particular, to compensate for some of that more expensive LNG, which they would have to use otherwise, so to compensate for the losses from Russia. That would be my third item on the agenda, where one could see the beginning of policies for the rest of the year, which will be important for us only 1 or 2 years down the road.
Just a quick follow-up on that, Christof. Do you think we've seen the back of the financial shock, the banking shock? Have they managed to sort of curtail it, nip it in the bud, so to speak, although Credit Suisse is a big bud? But do you think that's behind the markets now?
Of that short term, yes, but there's two threats out there. One is there may be more banks which have made mistakes as the Silicon Valley Bank. And the more profound threat is that as the adjustment takes place to higher rates of inflation and therefore higher nominal interest rates, and them not coming down as fast, then there may be ripple effects somewhere else in the financial sector, which we can't foresee, but which would be much more of a systemic crisis. This one here, again, was in retrospect, it's easy to say, but in retrospect, it was an isolated event caused by some poorly managed banks. I mean, basically, the risk policy of the Silicon Valley Bank, and then the long history of dubious deposit taking and fights with the regulatory part of Credit Suisse.